Hey everyone, and welcome back to The Explainer. Just a quick heads up before we dive in, you can turn on clear English captions right here on your screen. Today, we're looking at a fascinating and honestly kind of terrifying economic situation that's unfolding right now. We're going to explore whether South Korea's recent super dramatic stock market crash is actually an immediate preview of what's coming to the US market. Because as you'll see, this is a story about artificial intelligence, massive amounts of borrowed money, and just how fast things can unravel.
So to understand where we are, we have to look at where we just were. Literally, just 3 weeks ago, South Korea's KOSPI index was the best performing market in the entire world. It went on an absolute tear, surging nearly 200% in 12 months. I mean, compare that to the S&P 500, which had a great year at roughly 24%, and South Korea was just on another planet entirely.
But then, the music stopped. We have to contrast that euphoric rise with an equally dramatic, devastating fall. In the span of just 21 days, this supposedly unstoppable market suddenly collapsed, dropping by 25%. Trillions of won in investments were just wiped out in a matter of weeks, catching millions completely off guard.
Which brings us to the crucial question staring us right in the face. Could the US be next? Are we looking at an isolated incident halfway across the globe? Or is this foreign crash simply a faster, smaller version of an inevitable US market drop? Well, to figure that out, we need to look at exactly how and why the South Korean market became such a powder keg in the first place.
It all starts with the people. In South Korea, you've got intense cultural expectations to own a home and start a family, but those are colliding with totally unaffordable housing prices. Feeling completely priced out of real estate, an incredible 14 million South Korean retail investors who actually call themselves ants turned to the stock market. It was seen as their absolute last chance to build wealth. And they didn't just invest their savings, they went all in, using highly dangerous personal debt and leverage to maximize their bets.
Okay, let's dive into this. When you compare the actual structure of these markets, the fragility becomes pretty obvious. For a long time, analysts have pointed out the high concentration of the US S&P 500, where the top 10 companies make up about 36% of the total index. Historically, that's really high. But when you look at the South Korean market, the KOSPI, that 36% looks incredibly diversified by comparison.
And this brilliantly illustrates the real problem. Just two AI memory chip companies, Samsung and SK Hynix, made up a staggering 56% of the entire KSPI index. Over half of their national stock market's weight was riding on the success of just two companies. So you have 14 million retail investors, armed with heavily borrowed money, essentially piling into a volatile two-stock trade.
So what popped the bubble? Ironically enough, it was the United States. In late June, U.S. investors started getting really nervous ahead of an earnings report from Micron, America's biggest chip maker and a direct competitor to Samsung and SK Hynix. When U.S. memory stocks started dipping, that panic immediately traveled to Korea's highly concentrated market, triggering a devastating single-day drop of over 10%. It's a day Korean investors are now calling Black Tuesday.
Let's move to and see how this builds, because this is where the mechanics of borrowed money turn a normal sell-off into an absolute catastrophe. When a market is built on leverage, you don't actually get to choose when you sell. First, the stock drops. Second, your broker issues a margin call demanding you deposit cash immediately. Third, if you don't have the cash, the broker forcefully sells your shares at whatever price they can get. And fourth, all this forced selling drops the overall stock price even further, which just triggers margin calls for the next group of investors. It creates a completely inescapable doom loop.
To make matters even worse, a lot of these retail investors weren't just using standard margin loans. They were buying 2x and 3x leveraged ETFs. These funds literally multiply the market's movements. Now that's great on the way up, but it is devastating on the way down. Because of how these funds are structured, they have to rebalance their ratios at the end of every single day. That means these massive funds had to automatically sell millions of shares into an already falling market, pouring absolute fuel on the fire.
It is a stark reminder of how rapidly leverage can unwind a market. Really quick, if you're finding this analytical breakdown valuable, please take a quick second to like, share, and subscribe. It really helps us continue producing these data-driven explainers for you. All right, let's pivot our focus back home, because the warning signs blinking red in South Korea are starting to flash here in the US.
So, the crucial point is this. The United States stock market is currently floating on a historic ocean of borrowed money. As of recent data, borrowed money, margin debt, in the US just hit a record-breaking 4.5% of our entire GDP. This isn't just high, this is the highest level ever recorded in American history. It surpasses the peak of the dot-com bubble and the lead up to the 2008 financial crisis.
If we look back, tracking historical margin debt reveals a terrifying pattern. In 1987, it spiked right before Black Monday. In March 2000, it peaked at the exact moment the dot-com bubble burst. In July 2007, it topped out just months before the global financial crisis. Every single time U.S. margin debt has reached an extreme peak like this, a massive historical market crash has followed almost immediately. And today, we are at an all-time record high. But here's the truly terrifying part. That 4.5% margin debt figure, it's basically just the floor. Official margin data only tracks traditional loans at brokerage accounts. It entirely misses the hundreds of billions of dollars hidden away in modern, complex financial instruments. We're talking about those very same leveraged ETFs that blew up the Korean market, zero-day options trading at record volumes, and private credit. There's also a secondary warning sign indicating that the smart money might be looking for the exit right now. The U.S. market is currently being flooded with initial public offerings, hitting a massive 12% of GDP in post-IPO market cap. To put that into perspective, we're currently at over double the IPO volume of the 1999 dot-com peak. Historically, when corporations rush to list their companies like this, it signals that corporate insiders believe prices are as good as they're ever going to get. So what's actually holding all of this up? Well, the entire U.S. stock market currently rests on a really fragile pyramid. Down at the base, you have highly unprofitable AI startups like OpenAI. Despite losing tens of billions of dollars, they are driving the vast majority of all AI compute demand. This forces hyperscalers, the massive tech giants, to justify massive infrastructure spending, which then artificially props up the broader stock market.
Now, what's really interesting about this slide is it visualizes the singular tripwire holding up global markets. We are talking about hundreds of billions in AI capital expenditures by companies like Microsoft, Google, Amazon, and Meta. $376 billion in 2025, and an estimated $725 billion in 2026. This is the engine keeping the whole thing moving.
But what happens if they pull back? Because we've actually seen this exact movie before. Back in the year 2000, Coca-Cola realized it didn't need as much tech infrastructure as it thought, so they slightly cut their router orders from Cisco. That seemingly minor reduction completely collapsed Cisco's earnings expectations and helped trigger a devastating 78% drop in the NASDAQ. Today, if just one of those big four tech giants announces a cut to their AI spending, the cascading effect could be equally catastrophic. Now, figuring out exactly when a peak occurs is famously impossible, though some people look to some pretty hilarious coincidences. Enter the Shrek indicator. Purely by coincidence, every major Shrek movie release has aligned almost perfectly with historical market crashes, from the dot-com bubble in 2001 to the flash crash in 2010. And guess what? Shrek 5 is scheduled for release in 2027. Obviously, this is just a tasteful joke, but it highlights the sheer unpredictability of market timing. Jokes aside, the fundamental reality here is super sobering. Big tech's return on these massive AI investments is already dropping fast. Just a year and a half ago, they were earning about 40 cents of operating income on every dollar invested in AI. Today, that return has been slashed in half, plunging to just 20 cents, and it's trending toward 10. As these returns continue to shrink, the likelihood that they drastically cut their capital expenditures increases by the day. Yet, if you listen to mainstream market analysts today, their confidence is entirely unshaken. It eerily echoes April 1912, when the vice president of the White Star Line famously stated they had absolute confidence in the Titanic and believed it was unsinkable. The crazy part? He made that statement after the ship had already hit the iceberg. The 14 million retail investors in South Korea also had absolute confidence in their market just a few weeks ago. Which brings us to the ultimate question, posed by legendary financial analyst Jim Chanos, that you should really take away from this explainer. At what point do these tech CEOs look at plunging returns and ask, will the next $1 trillion in AI spending actually make sense? If the answer is no and the spending stops, we are very quickly going to find out if the U.S. market's fragile, historically leveraged foundation can survive the impact. Thank you so much for joining me on this explainer. Stay informed, stay careful out there, and I'll catch you in the next one.